My name is Dennis Price with Impact Alpha. The ownership economy, ownership lens, particularly employee ownership, has emerged as a viable impact strategy, investment strategy, with the hopes to address wealth inequality, build resilient communities, and drive long-term business value creation. The ownership economy has arrived, we wrote in Impact Alpha a few weeks ago. But of course, it didn't just arrive. Decades of work has gone into testing models, tweaking practices, and learning valuable lessons. Now, as investors look to add employee ownership strategies to their portfolio, we know more about what works and to what end. What does an ownership culture look like? How can it unlock business value, as well as benefits for employees and communities? And what role can investors play? To help us get concrete and get beyond the hype, please welcome Melissa Hoover, Executive Director at an Executive Fellow at the Rutgers Institute for the Study of Employee Ownership and Profit Sharing, and the founder of Democracy at Work Institute. Melissa is currently the Institute's Director of Special Projects. Julian McKinley, the Co-Executive Director at Democracy at Work, a national think tank and do tank expanding worker ownership across the U.S. And Amelia All, the co-founder of Haifa Collective, a worker-owned cooperative focused on advancing a regenerative economy through research, change management, project facilitation, and also serves as the Director of Impact at the Builders Fund. Welcome, everyone.
Thank you.
Melissa, let's begin with you. Like I said, the ownership economy, and specifically employee ownership, is gaining a broader audience. You've been building this space for 2 decades. Tell us a bit about why you founded Democracy at Work Institute.
Well, DAWI was founded at a moment in time, it was about 10 years into national organizing among worker co-ops. It had formed a trade association, and the notion had always been to have a partner nonprofit. But what we were really seeing was a shift, like a sea change in who was interested in worker-owned and employee-owned forms, from people who had options using the form to exit the mainstream economy. The shift was toward people who didn't have options, who were locked out, using the form to enter the mainstream economy. And for us, that was really exciting, interesting, and I think it's a helpful frame for our conversation today to sort of understand that a lot of what has animated the growth in employee ownership over the last 10, 20 years is really entrepreneurs of necessity. So they're not disrupting anything but intergenerational poverty, right? Their killer app is shared ownership. It's people who are driven towards entrepreneurship because they are locked out of other options to some degree. And so we wanted to meet that need. We saw that happening. And I think that it demands a sort of rigor for innovation and scale to meet the kind of equity challenges. So we were designing Democracy at Work Institute for the worker owners, not of the present necessarily, but of the future, because we could see this sort of flywheel effect when we engaged in equity, innovation, and scale-oriented thinking to meet the needs of people who were driven towards employee ownership for new and for us exciting reasons.
And fast forward a few decades, and there's now a number of, there's hundreds of companies that have now adopted this, and recently more and more investment funds. One of them, who we've enjoyed covering, Apis and Heritage's Legacy Fund. I don't know if Todd and Philip are in the audience, right here. Was incubated at the Democracy at Work Institute. How did that come about, and why was it the right time?
Yeah, so it's a funny story. You know, if we're aiming to meet the needs of this emerging group of employee owners, we have to look at new forms. And Todd Leverett, one of the founders of Apis and Heritage, was working at Democracy at Work Institute. We had him running around the country, basically talking to business owners, trying to persuade them to sell to their employees. And after about a year of that, he came to me and said, I don't think this is effective, actually. Something is missing. And we had a frank conversation. And we both, I think, were of the opinion that the indirect approach was really difficult, trying to persuade someone to do something. But if we could bring capital to it, that could be a driver. So we were focused on this capital question. Todd had the vision. I went out and raised the money from a set of visionary funders, Kellogg Foundation, City Community Development, and Candida Fund, primarily. And they basically gave us runway for 9 months to a year. Phil came on board, they worked out the model and the vision, and then the rest is history. They launched, they have spun off. I think it's a really instructive example of a few things. One, the courage to name when something isn't working and pivot from it. It creates opportunities for new things, but it's really hard to do in the nonprofit world. The incentives are to sort of claim that it's working and you just need more money for it to work better. So we took a real risk as a nonprofit organization to do that. And I think the other kind of instructive thing was the strategic use of philanthropy. This came up in a workshop yesterday, that there's a role for philanthropy in incubating and catalyzing market-based solutions initiated by people who aren't themselves bringing their own capital to the situation because they may come from historically underrepresented groups that just may not have the access and resources, but given those resources for 9 months to a year, in our case, they could really launch something.
And we're going to get into a few of the strategies, but just say a bit more about the strategy of the fund, what it's actually doing, investing in and doing, and then your work continues with them. So what does that look like?
Yeah, so the Legacy Fund is a credit fund that finances mostly so far retiring owners to leave their business and implement an ESOP, which is an employee stock ownership plan, in their place. So an ESOP is essentially an ownership structure where a trust is the main owner and the employees are beneficiaries through that trust. And they finance that along with local banking partners. So Democracy at Work Institute has stayed connected to A&H and the Legacy Fund. We do the ownership culture work in the companies. I think that this is called a human capital operating partner, but that sounds gross to me, so I'll just say we do the ownership culture work. Our work drives value, it mitigates risk for the investors, and it's the work that, the work of engaging employees, developing human-centered systems, all that stuff drives the impact that the Legacy Fund is seeking, in addition to the financial impact. So that's the main thing we do. We also measure that impact in a pretty rigorous way. We produce an annual report, and then we're committed to sharing learnings and tools and lessons with the field per our public benefit mandate and our philanthropic funding for the work.
Thank you. Well, let's dig in a bit around what ownership actually looks like. We hear the word thrown around a lot. What is ownership culture, and what forms is it taking in businesses?
Sure, thanks, Dennis. So, ownership, the word is used a lot because it can take many different forms. It's something typically that people are very familiar with, just broadly as a concept of entrepreneurialism. But ownership in this context, I like to sort of put along a spectrum. And I'm going to sort of paint with a broad brush here because it's 9 a.m. We're not going to go into like the real specifics. I don't want to send everyone back to bed yet. But again, it's along a spectrum. And there are 3 areas in particular that I would highlight. One is just general profit sharing. This might look like a set of employees owning shares in a company, typically designed to create a benefit when those shares are sold or the company is sold. So it's a one-time payout. Then we'd look at broad-based employee ownership, right? And so this is typically ESOPs, which Melissa mentioned. Here, you're looking at expanding who is benefiting financially from the success of the company. Owning shares, again, but ownership can go anywhere between 30 and 100% of employees within that business. Not typically meant for the business to be sold, but if it is sold, those employees would benefit again materially. It might also provide an opportunity for those employees to build a nest egg for retirement in addition to their 401k. It might help, send their kids to college, that type of thing. And then we get into what we would call democratic business ownership or worker cooperatives. And here, you still have profit sharing. Profits are shared with the workers in the business who collectively run and manage the business. Those profits are shared typically annually. And then the important part here is that those workers together make decisions democratically to run the business. Now, our work focuses specifically on the set of businesses that combine profit sharing and ownership culture. It's an important distinction because there is really an inherent misalignment between labor and enterprise in terms of what their goals are. So if I am, for example, an hourly employee, I'm living paycheck to paycheck, I'm coming into work from the orientation of, I want to come in, I'm clocking in, I want to get my work done to the extent that my supervisor's not, breathing down my neck, I want to clock out and get my paycheck. There's really no incentive for me to go above and beyond, and in those conditions, there really shouldn't be. There's no reason. The flip side of that is the business really needs me to be as efficient as possible. They thrive in productivity. In the absence of those things, there is a need to increase managerial oversight, costs go up, productivity slows. But if I, from the employee standpoint, begin to benefit materially from the company's success, so when the company is more productive, I see more money in my pocket, essentially. And when that company shares information, like opening up its books, helping me understand how my daily tasks really contribute to the bottom line of the firm, then my orientation to the work changes, my orientation to that company changes. And that when you take that to scale within a company, it really supercharges productivity. It's transformational. Loyalty goes up, productivity goes up, and that's where we really see what we would call unlocking full ownership.
So that idea of ownership culture as the way to get to the benefits of ownership. So it's a bit hard to characterize the sort of increased investor interest in this space, but how would you characterize it, and why now? Why do you think this is sort of resonating, especially in the impact space?
Yeah, it's interesting. So employee ownership is definitely having a moment, if you will. There is, as you said, an increase in investor interest, an increase in funds that are investing in employee ownership. There's a good deal of research out there that captures this trend. I want to sort of name just a few folks because our work really stands on the shoulders of others, thinking particularly Transform Finance, Allison Lengane and the Ownership Capital Lab, Social Capital Partners, and a few others. So way too many to name. I'm going to pause there to refrain from forgetting someone and upsetting someone. But Transform Finance in particular, they've done a really good job of capturing what this growth looks like. There's a database that they've created. I think Impact Alpha actually wrote a good piece on that. I encourage everyone, if you're interested in what these funds look like, to visit transformfinance.org. And what their research says is that over the past 5 years in particular, a quarter of the funds that exist that are investing in employee ownership were started. So there's a moment in time where these funds are coming together, they're launching, they're investing in employee ownership. There's also, along with that, an increase in the investment in those funds, right? And there are a couple of reasons that I would point to this. One is the champions. You mentioned earlier that this work has been going on for decades and decades, and there are several champions who have really just done a great job of beating the drum and building a foundation so that this moment is possible. Folks like Joseph Blasi at Rutgers, Melissa, and so that work has really contributed to raising awareness generally and inserting employee ownership in the mainstream conversation. The second one is innovation, and so things like 8% Heritage. Private equity's entrance into the employee ownership space. This has done a great job of getting visibility on the forum and opening the conversation to what does ownership really mean in our economies and how do we expand it as an opportunity to build wealth. Employee ownership, I should say, was on 60 Minutes this year. It wasn't the first time that it happened, but it's significant. And we're here at SOCAP. There are several sessions over these days that are about ownership, and so the publicity, that visibility, really cannot be ignored. And the third piece is philanthropy. Philanthropy has done what other folks cannot do. They went where others were sort of skeptical to go. And they made bets where they saw the potential to make impact, and the research backed it up. Candida, Kellogg, Gary Community Investments, and some others, have really said employee ownership is a place where we can see the impact we'd like to see in our community. So they went there, and with them taking the first steps, they attracted other investors.
And even with the uptick, I think very few investors, or let's take the LPs that invest into those funds, would consider themselves an ownership investor. These folks have other sort of impact objectives in this space. How, for new investors coming into this space that have other goals and now are seeing ownership, how can an ownership strategy help unlock those other impacts?
Yeah, so it's interesting because you know, the impacts of employee ownership are well documented, right? They save jobs, they anchor jobs and businesses and communities, they create wealth building opportunities for workers. But, you know, Rutgers in particular has done a great job of publishing a couple of studies that demonstrate it's not just profit sharing alone that creates, you know, the positive impact within the company or socially that we want to see. It is profit sharing and participation, that ownership culture element. For investors who are thinking about, you know, can I use business as a tool to achieve the social change that I want to see? I'd really encourage them to just take a look at, number one, the power of business ownership and the need that's there. So thinking about the fact that, number one, we are living in a business closure crisis. 10 million businesses that are owned by baby boomers are disappearing from our communities every single day. Exactly, right? And when they do want to sell, only 1 in 5 business on the market actually sells. And so those businesses are really just disappearing.
To private equity or other
Exactly.
companies. Yeah.
Yep. And so we're also in the midst of a Black business ownership crisis. 400,000 businesses that were Black-owned disappeared in just the first few months of COVID alone. That's 40% of Black-owned businesses. And so there's this incredible need for ownership, especially, again, when we consider the impact that owning a business can have on a family. And so putting the value of a thriving business in the hands of working families can really be transformative. Again, you have to think about what the research says, and that's it's not just profit sharing, it's profit sharing and ownership culture that really unlocks those other pieces. So when you're getting to, okay, how do we reduce the racial wealth gap? How do we think about the larger health impacts? Again, how do we get beyond profit sharing, just profit sharing, and it's really those ownership culture pieces that allows you to really go beyond. So that's where investors should really take a look.
Fantastic. And one of the benefits of being a few decades into this work is there's actual research that we can look to. Amelia, you've been doing even more recent research. Before we get to what you're learning, what sort of data points are out there? You know, what are you looking at in terms of trying to understand these practices and models better?
Right. Yeah. So ownership is not new, as we've been saying. It's been around for decades and decades. And in starting our research, we wanted to document what existed, what's out there. There is a significant amount of data on ESOPs in particular. For the purposes of our research, we really focused in on ESOPs and on worker co-ops as models that have that opportunity for both ownership and the ownership culture. So ESOP data is widely available. There's decades and decades of it, and generally points to quite positive outcomes in terms of business performance and in terms of social impact. So, for example, there's a study from 1986 from the National Center for Employee Ownership that looks at employee-owned businesses that have higher levels of participation compared to their peers, so more of that ownership culture feeling. And those businesses outperformed in terms of sales and business longevity. And you know, attributing that again to an enhanced sense of ownership in the businesses. There's Rutgers, which we've been talking about, where Melissa is a fellow, has been studying employee ownership and the impacts of profit sharing also for a very long time. They have an institute with access to, I think it's 9 federal employment databases. There are 200 plus research fellows there that are looking at questions of ownership from the perspective of economics, from sociology, and they're putting out quite a bit of research that looks at the outcomes of these businesses. So in 2000, there was a study on ESOPs that pointed to higher rate of sales and increasing rates of employment that are far outcompeting their peers. So in general, the research is looking at outcomes from a number of perspectives, business performance, so looking at resilience, growth, profitability, those pieces. On the employee side, the research is looking at things like employee satisfaction, recruitment, retention rates, job quality, so kind of a blend of qualitative and quantitative data. And then on the community side, kind of a wider looking lens, we're seeing research that documents like the diversity of employee-owned companies. Like Julian was mentioning, often these businesses are coming from maybe low-income communities, frontline communities, communities where there are a lot of Black and brown workers. And so the research space is starting to document some of that. In addition to the diversity piece, it's also looking at companies' resilience and longevity. So worker-owned enterprises tend to stick around and weather tough times. We saw a lot of this through the COVID-19 pandemic and in the aftermath. Worker-owned businesses are less likely to pack up and leave and more likely to really hold it down and try to keep jobs locally. And keep money in local communities. And then an interesting piece on that kind of community side is also civic engagement. So folks who are in active worker-owned enterprises who are participating in democratic management processes, they're kind of really living that process. They're living those values and they're embodying democracy. And there's a recent study from Dowie assessing the wider landscape of worker owners that actually showed that there's higher participation from worker owners in the midterm elections, for example. Oh, wow. It was like 11% higher voter turnout for worker owners compared to other employees.
So interesting, yeah.
Yeah, there's many different approaches, many different angles you can look at to kind of get a sense of what the impacts are.
So it seems like the impacts are fairly wide, and in particular interesting on business performance, because I think for folks first time looking at this, that may be counterintuitive. And then everyone sort of touched on it's not just ownership, it's participation. Can you say a bit about what the studies are showing about what participation looks like to get to those outcomes, or other learnings on the actual practices?
Yeah, so, so I want to talk a little bit about first just why we did this research. And yeah, we've been really putting a fine point on this, like participation is incredibly important to get the full spectrum of benefits from worker ownership. So we've talked about the growing interest from the impact capital space in employee ownership, and we've been really excited to see that because we see, the benefits of ownership here. So what we've wanted to do is provide a resource for investors who are interested in wondering, like, is this the right space for me? Is this something I should consider building into my impact portfolio? And I know, like, many of the folks who are here at SOCAP are interested in impact focuses of climate justice, place-based investing, increasing wealth equity, and reducing pay inequity. So those are all potential avenues that can be benefited from worker ownership. And so we wanted to really paint that picture and help draw some connections to impact frameworks so that folks can start to understand, is this a space where we should be spending time and should be thinking about investing in.
What's missing from the evidence base from your perspective? Now you've sort of done the landscape and some other research. What would be more helpful to understand how to make this all work?
Yeah, so I think like I mentioned, there's quite a prevalence of ESOP-focused data. To a lesser extent, there's data on the outcomes of investing in worker ownership from a co-op perspective. And so that's something I think we would like to see more of. That's something that we hope to kind of fill in a bit with the research that we've done, because we've gone out and talked specifically to worker owners who've gone through the conversion process to hear, what their lived experience is like. That's something that I think the work with DOWI and APIS and Heritage is also hoping to address, this kind of longer-term impact management approach to really developing these positive recurring feedback loops with workers to say, what is working, what is not working, how is your life being impacted? And so I think there's a need for more data along those lines in the ownership context, but I also would say to kind of zoom out into impact management and measurement in general, that is the direction that this field is headed. We're moving from outputs data of like jobs created or, waste diverted from the landfill to outcomes data to really understand what is the material change in people's lives or what is the material change to the environment that we're trying to affect. I was at the opening plenary session on Monday this week and heard the discussion from TransCap talking about systems investing and saying, we need to move from outputs to outcomes, and I think that's very, very much the case in the ownership space. And one of the advantages here is that organizations that have a robust ownership structure and culture are already practicing outcomes. They're living into that. You can't have ownership culture without transparency, without feedback loops, without information sharing, and those are core pieces to really effective impact measurement for investors. And so I think there's a really strong potential there for investors to really benefit from that, to say, okay, well, if I'm going to invest in employee ownership and a strong ownership culture, I already know that we're going to be, participating or practicing these feedback loops, this transparency, and that's going to help me really be in touch with what the impact that I'm seeing and understanding over the long term. So I think it's actually a real value add. And
unlocking the business value as well.
Exactly.
And I don't want to dwell on this too much, but maybe just back up and can someone share, like if you're a boomer and you have a business and you have 20 or so employees, or you're a mechanic perhaps, what does it look like to convert? What are the questions you ask? How do you think about models that you might adopt? So what does that conversion process look like for an entrepreneur?
Yeah. So typically, as far as models go, there are a couple of things that will determine exactly what's sort of feasible. And in most cases, it's the size of the business. So if you've got a business of 200 employees, you're really not going to be converting to a worker cooperative. Okay. You would, at that size, really look at an ESOP. There's a lot of, nationally, there are technical assistance providers who will walk a business owner through what employee ownership conversion might look like. Begins with, is it really a right fit for you? Is your business profitable enough to really go through this conversion? What type of exit for you as an owner do you want? Are you looking to step out today, or will you be here for maybe 5 more years? We can plan. Are you comfortable with thinking about the types of technical assistance that's required to share information with your workers, get them to understand the financials, thinking about building that ownership culture mindset. There are, I think, in addition to, we mentioned some of the funds that have been started over the past few years, many of those funds actually couple their services with that ownership culture piece. So the TA, that is very intentional. That's sort of just the basics in terms of what that might look like.
I can piggyback on that a little bit. So this is our bread and butter at AMH. It's what we do all day, every day, talk to hundreds of business owners around the country. And I think, there's this kind of myth you hear from selling business owners. Selling your company to your employees is long and expensive. And I would say just remove the to your employees part. Selling your company is a long and expensive process. It just is. The employee ownership dimension might add a little bit of complexity, and there's this sort of the follow-on looks really different, which is why we emphasize ownership culture as a risk mitigant. But really, selling your company to your employees is not a whole lot longer or more expensive than selling it to anyone else. And then I think to zoom out a little bit, how this stuff is financed and sort of what business owners' options are 4 out of 5 businesses for sale are not going to find a buyer. So they're going to close up shop or consolidate, or, you know, those productive assets will be lost or rolled up into a more consolidated form. The vast, vast majority of small business owners in this country are white men. The vast majority of people who work for them are not white men. And that hinge between who owned the business and who will own the business is the thesis. I didn't say it earlier because it's sort of the air I breathe, but we need to be explicit about this. For the A&H model, we are focused on low-wage workers and workforces of color. So when you look at the dynamics between business owners, it's sort of impossible to generalize about how business owners, for instance, feel about their employees, or how they're going to respond to the introduction of ownership culture. That's a pretty individual thing. What you can generalize about is that, first of all, most business owners do think their businesses are worth more than they're actually worth, so there's a long negotiation process to get to the right price. And particularly with ESOPs, it's important that the workers not overpay for the asset. And it's particularly important when we talk about low-wage workers who don't have a lot of cushion for, for there to be an overvaluation of the business. The reason the ownership culture work that we do is so important is because very often the owner has not invested in systems of transparency, in HR, in the sort of human-centered kind of like advancement pathways for employees. The sort of, and again, it's really impossible to generalize, but there are sort of tendencies to see workers as a cost and labor as an input. And the shift in mindset for us is to see workers as the beneficiaries and owners of the business, but also as real value drivers. And so to give them pathways to contribute to that value. And the power dynamics are real there, and they are not automatically mitigated or offset by sharing ownership. By sharing ownership, there has to be a very intentional and equity-focused process to sort of implement the kinds of things that are going to actually make it work.
Mm-hmm. Let's drill down on those because that seems to be where the magic's at, the ownership culture, to get to either the business value or the benefits to employees and their families and communities. There's this other sort of discussion around quality jobs in this space and what good jobs look like. Let's drill down on like some of the practices of ownership culture, like in the research, perhaps, Amelia. What are we seeing, like very tangible practices that would, create an ownership culture?
Sure. This is, I think, something that Dowie's building a framework out for, is understanding what are the elements of ownership culture. And we've talked a little bit about some of them. It's kind of like, how do we measure participation and the feelings of, I have a vested say and sway in the business. And so that can, I think it kind of falls along a spectrum. And it includes things like open book management and open financial management, conversations, kind of information sharing and transparency kind of on one end of the spectrum. So having that free flow of information, and then moving along the spectrum, it moves towards more active participation and real ownership of those processes and decision making. Material to say over who comes in and who gets hired and what roles people take in a business, decisions around financial practices, decisions to whether or not to sell. I think we kind of think about ownership along a spectrum, and every organization can kind of move in that direction towards more holistic, more meaningful ownership. And it's really like, feeling that material, tangible outcome of like, well, it's not just someone's listening to me, but actually the voice that I have translates into action.
Like not just ownership of the company, but ownership of process. And Tell us more about the framework.
Yeah, well, there's also, I think, sort of informal ownership that shows up. And I gave the example of like the hourly employee earlier who's maybe disconnected from feeling, disconnected from the company at large, but that transforms when you bring in participation. That worker, they are very, very familiar with their daily tasks. They know them better than anyone, certainly better than the folks who maybe supervise them. When there is participation, that worker is going to naturally begin to identify opportunities to increase efficiency because they see the impact that it has on the overall business and then in turn on the amount of money that they're getting back through profit sharing. And so that power, an opportunity for that worker to shape not just how they're going about their work, but how the company as a whole performs is sort of an informal thing that shows up, but is it's very important to note because it shows up on the balance sheets, on the bottom line of the company.
And maybe just to put like a story to that, what you just shared is, so one of the businesses that we interviewed for our research is a worker-owned cooperative cleaning co-op based out of Minnesota. And the person that we talked to shared a story of so in the couple of years post co-op conversion, this is a small team of, I think 17 employees, and they really bonded together and built a high level of trust because they converted to a co-op right during the pandemic and had to, scramble to put their heads together to figure out how are we going to weather this storm, how are we going to stay open, we can't go into people's homes. And they did that and built a high level of trust and new systems of decision-making and ideation as a team. And one thing that came from those new processes was somebody started experimenting with the cleaning formulas that they use. So they had always tried to use organic and non-toxic chemical-free products in their business, and somebody started experimenting with, well, what if we make our own cleaning solution in-house? We can lower the cost of instead of buying it in bulk, and we can actually make it even less toxic, more healthy. And so they this was just like a person who had started as without a leadership role, was just working in cleaning houses, but they offered, some small innovation to the business model that helped save them money and helped make them an even more, impact-oriented, safer business.
I think those are the kinds of things that everyday businesses would kill for, right? To have employees that are engaged in sort of their own accountability for efficiency and innovation, and there's just not the incentive, right? If you don't own it, unless maybe there are bonuses and things like that. But at the end of the day, it's the shared ownership structure that kind of holds down those practices. It forces them in some ways. But I think there's this. We can tend to exoticize ownership culture as something that's only present in employee-owned businesses. And it's true that the ownership is only present, but those kinds of best practices, I think, are relevant. So it's a spectrum, right? The best practices of engaging employees in innovation, in a coaching approach to management that's a strengths-based and sort of fostering advancement. Those are good practices for any business. I actually think we have this treasure trove of good practices that could be shared more broadly and are really, really valuable. They add value to any business. And then kind of at the far end, there are the specific forms of employee ownership. So for us, ownership culture involves teaching about the ESOP so that people really understand it. For worker co-ops, it may involve participation in the board and democratic governance. At A&H, we have an employee on the board that's elected by the other employees. It's often the first time people have ever been asked to vote on anything at work. So we sort of prepare them to run, we prepare the group to vote. There's the spectrum of practices, I guess, is wide, but some of them are really relevant for everyone.
We'll say to the audience, if there's questions, there's the index cards floating around. Just jot your question down and hand it to one of the volunteers, and we'll come back to those in a bit. But we talked about sort of investors that have perhaps not ownership isn't their end goal, but they, racial equity or, health outcomes or community outcomes. Are there different practices within ownership cultures or different models, different ownership models that folks should be considering given the sort of the outcomes that they've set out to achieve?
So, I would say that what's important here, I think, is intentionality. What is the exact outcome that an investor wants to see, that a business wants to see, and then how are you going about achieving that within the business? We've mentioned multiple different approaches in terms of different forms of employee ownership. All of those have different financial beneficiaries. All of those offer different opportunities for employees to engage. One of the things that I think has contributed to the success that 8% Heritage and Melissa's work has seen is, or one of the reasons it's been so successful is because of that intentionality. Identifying exact sets of workers that they want to work with. So in many cases, these are Black and brown workers in essential industries, low-wage workers generally, going in and creating culturally appropriate technical assistance and training, delivering it into, I think, in many challenging conditions. So workers who aren't even in an office every single day, they're out in the field. So how do you really support them to connect with the business and contribute at that ownership level? And then measuring it as well, right? So taking a look at, within all of the trainings and things that we're doing, how are we measuring our progress towards those other outcomes? That's, I think, a critical component, the intentionality there that contributes to success.
For me, it's sort of a Maslow's pyramid of impact, right? So at the bottom is the material benefit. Like in A&H companies, after a year and a half, some of them not even a year, but average across our portfolio, workers have in the low 4 figures in their ESOP accounts after just a year of ESOP participation. Over the lifetime of the business, we expect that to grow to the 6 figures, at least, without making any forward-looking statements or promises. But the idea is this gives you a financial asset, a retirement account that resonates well beyond the individual worker. It's to their families and communities. And we've seen examples of Phil, I think yesterday, cited this really powerful vision that we won't see the true impact of that for a couple generations when people cash out of their ESOP and use that money to help their kids buy a house. That kind of thing. And so that's the base for me, but then we can sort of see all of these other impacts that stack up on top of that. There are the civic spillover effects. There are the sort of feeling of the job satisfaction and job quality at work. But low-wage workers are overall not super satisfied with their jobs, it turns out, and the job quality is not great. So if we can make a dent in people's everyday lives, in addition to their retirement account, I think we're good. There was an interesting imperative for one of our investors, which was, their focus is health and wellness. And so they wanted us to track health and wellness. They were really open about what that meant, but they wanted to look at individual health and wellness. So we added a whole question to our annual employee survey, a whole set of questions about your average healthy days. It tracks to national indices so that we can benchmark it. How stressed are you? Your psychological stress, your physical stress, your injury rate, that kind of thing. And if we hadn't been urged by our investor to track that kind of data and look at that kind of impact, we wouldn't be tracking it. What it has done is told us that benefits are number one. So it's changed our model a little bit in that as we're surfacing these needs from employees, access to benefits, access to even just sort of things like basic safety equipment and work boots, that kind of stuff is not always present in the minds of investors, but makes a really huge difference on a daily level for people who work in employee-owned businesses. And so there's this sort of dialogue between the data and the priorities and then our actual practice.
Let's stick on the investor component for a bit, because I feel there's perhaps some in the audience. Like if you're at an investment fund investing in companies in the Southeast United States, like in what ways should you approach this conversation very practically, like due diligence? We've talked about impact management, sort of once the investment goes. How are investors adopting this lens through their sort of life cycle?
Yeah. So Melissa just mentioned something really important, and that is that the impact, the financial impact that you want to see for workers, it grows over time and it takes time. And so there's a need there for patience, but also, again, the right investors are going to identify an opportunity to create large impact, again, over time. It's not something that's going to happen tomorrow. And so are they able to invest in ways that include, again, the patience, the time, the right infrastructure and supports for that business to be successful? Are they measuring the right things? Are they investing in measurement so that you can, again, identify where you need to make changes or pivots, like the health example that Melissa gave. One thing I think that is sort of like a great entry point for new investors is investing in those funds that I mentioned earlier, funds like A&H and the other, Mosaic Capital, other funds that are investing in a broad set of businesses. That way, they're able to take advantage of the expertise that those funds have executing those deals. They have a long track record of success, but they're also able to take advantage of, again, the technical assistance, the ownership culture pieces that come along with those funds.
I think, I would echo all of that, and then I guess I would say, A&H is one of the first movers in this space with the equity lens. And so what we have seen was they had some really bold initial investors who were mission driven, but they are also it's not concessionary. Like, they're offering market rate returns. Now, are they offering like venture capital unicorn style returns? No. These are essential businesses in the everyday economy, landscaping, plumbing, nursery, healthcare, and so that, they're really good, solid, profitable businesses. Investors are getting returns on their money. And I think that's a really key part of our vision is like, there are always trade-offs. And I think, there may be other funds and other investors who are taking riskier bets or making concessionary investments. In our case, we believe that it's possible through the tax breaks that are available to ESOPs and the turbocharged growth that comes from ownership culture for everybody to get paid what they deserve out of that transaction. The selling owner, the investors, and the new employee owners.
Speaking of transform finance, Julie Mentor has I love this question. Do you think building the economic power of workers can help shift the political power and dynamic in the U.S.? Kind of interesting, the role of unions in doing exactly that. What's the role of employee owners in doing that?
I'm of two minds about that. So one mind is, of course, when people participate in democracy, when they participate in their workplace, they feel a sense of their own power, they become more educated about the conditions that their business is operating in, and therefore about their community. And we do see these spillover effects, and we hope for that, is on the one hand. The other mind is, do we need to overload employee ownership with doing all the things? Or should it just do the thing that it's good at and reserve space for things like labor organizing and building power in other ways? I think there's a world in which all of those things are needed and possible. Well, it's this world, actually, in which all of those things are needed and possible. So, I think it's a really open question and an interesting one.
Sort of the flip side of that, here's another question, is what can governments do to promote employee ownership, particularly local governments?
Ooh,
and maybe even if there's sort of, I know there's sort of federal level policies on the books. I know there's some emerging policies, if someone could share an update on sort of the federal level policies, but local and federal role in supporting employee ownership.
So I'll start and talk just a little bit about the local. I don't know if you want to add in on the federal updates. So at Dowie, we've actually worked with a number of municipalities over the years to learn about employee ownership, learn how they can use conversions in particular to ESOPs and worker cooperative forms to do things like, preserve businesses, legacy businesses in particular, keep them rooted in communities, reduce racial wealth gaps. From a local standpoint, there's just so much that could be done. There's not a lot of policy at the local level that supports worker ownership. So I mean, you could really talk about it across the board in terms of like, procurement, really like, also investing locally in the awareness building and technical assistance that's required to educate business owners about succession planning, about what it means to be a worker-owned business or employee-owned business. We're actually in the next year engaging a broader set of cities, bringing them on to engage folks within economic development offices, mayor's offices, and community organizations would love and are going to need really to move local capital. So community foundations, family offices, and the like. There's a huge opportunity there to think about how do we build an ecosystem. And there are a couple of examples to point to. Chicago recently, has provided $15 million to a whole wealth ecosystem building initiative, and worker ownership is a core part of that. New York City was really a leader 10 years ago now, providing city council funding to, I think it's around 13 or 14 nonprofits who have been building an ecosystem over that time. So hundreds of worker cooperatives have been started. Hundreds, or actually thousands of business owners have been educated on what it looks like to convert. We're starting to see a lot of growth as well, in California in particular, with a number of different focuses. Melissa mentioned early on those entrepreneurs of necessity. We haven't talked about this a lot, but these are folks who typically just don't have access to good jobs. They certainly don't have access to business ownership. And so they're coming to the Worker Cooperative Forum, typically through worker centers and through support from organizations like DAWI, to say, how do I really transform my experience in the workplace? And these are high violation workplaces. Typically, we're thinking about home care, child care, cleaning businesses. Folks are able to really just take ownership, immediately see higher wages. They're immediately able to see safer working conditions, more consistent work, that type of thing.
And we know that when cities fund the development of worker co-ops and supports for employee-owned businesses generally, that they flourish. Like, it's a no-brainer, and it's a pretty small amount of a city budget. I think what I'd really like to see is support for employee ownership embedded in systems like the workforce development system. There's no reason workforce development funding can't be used to train and skill people to run their own businesses, to understand employee ownership forms. Economic development incentives can be used to prioritize employee-owned businesses, and business retention strategies, should definitely incorporate employee ownership. And I think at a systems level is where we're actually going to see sort of support for scale. We know, like at the state level, for instance, in Colorado, with just a small amount of funding for feasibility studies for owners who are looking at selling their businesses, and a tax break for employee-owned forms, has really catalyzed a huge amount of growth, in their ecosystem. So it's and then we can look at, sort of really wonky things like contracting, like if employee-owned businesses are delivering a higher quality, more efficient service in a best price contracting model where it's just sort of lowest bottom dollar, they may not win. But in a best value contracting model, which is like kind of a more holistic approach, employee-owned businesses are really well positioned for that. So we can argue for changes that play to our strengths. And as federal money comes down for pandemic relief, for rebuilding, for addressing the systemic inequality crisis in this country, I think we need to be thinking about how that money flows through states and cities to the kind of business forms that are anchoring productive assets in service of building wealth that's broad-based.
Yeah, I might add also, I think just to answer both of these past two questions around the policy landscape and around the political leverage of worker-owned businesses. Julian, you shared a bunch of great regional examples, and one that I'm familiar with is here in the Bay Area, the network of Bay Area worker co-ops, aka No Boss, which is a great name if you all caught that. They are doing a lot of political advocacy and organizing, and that's kind of one of the tenets of the cooperative ecosystem is collaboration amongst co-ops. So I think co-ops are not an answer to they're not the answer to improving our democracy, but they are part of a wider system approach to how we might make those improvements. And they tend to operate in that way just by their very nature. And so No Boss has a small business organizing collective that they've started that's very grassroots, very self-governed and organized, and actually extends beyond the confines of just worker-owned businesses into small Black and Brown-owned businesses in the East Bay specifically. And they're basically building a coalition to say, like, what policies are going to best benefit us as business owners of similar size and scale who have shared interests, and they're doing coalition building, they're doing local advocacy, they're going up to Sacramento to talk to the state government, and so I think that's a really good example that can and is replicated regionally of they're advocating for their businesses, but also for local policies that are going to have a benefit to the wider population.
There's a couple questions on practically how businesses finance these conversions. So, for example, how are low-income workers expected to have the capital to buy the assets, number one, and two, how do you decide whether to go out to an outside investor or somehow either fund it from employees or through revenues of the company? So I think there's some clear answers to that, which is...
Yeah, one really critical thing to know about the ESOP model and A&H's model is that employees don't buy anything. It's a grant of company stock to them. So at the roughest contours of how the deal works, A&H Capital buys out the selling owner. The owner may hold a small note or sign a contract to stay for the succession period, and then partners with a local bank to finance the implementation of the ESOP. And then the ESOP is essentially funded out of company profits, which are increased due to the tax break and the supercharging of the productivity. So it's a grant to employees. The businesses, I have to explain this whenever I do a training. The owner sold the business, but you didn't buy the business. So how are you an owner now? And the notion is that there's this third party that finances the implementation of the ESOP, of the trust, which benefits all of its participants. And ESOPs and that's 100% ESOP model. You can do partial ESOPs. I think one of the key differences to understand is that's a business transition strategy, an exit strategy for an owner, a succession strategy. By and large, there are some transitions that are structured as cooperatives, in which case workers do buy in, usually a much smaller percentage of the total than you would if it were a sort of a sale to management or to another company. So there's financing that supports that. But worker co-ops are by and large, well, I don't know actually, what's the proportion of startups versus conversions? Do you know?
Oh, wow. So, well, I mean, the proportion of conversions is growing. It's certainly growing over the years. I want to say it's about 30%.
Okay. Yeah. So typically they're started as a job creation strategy, or a revenue generation strategy, or a business ownership strategy. So it's a startup, and they're bootstrapped, and there isn't enough equity investment for worker co-ops. And sort of my wish list for financing those startups would be equity that's partnered with technical assistance and expertise. Because again, if we go back to entrepreneurs of necessity, may not have some of the background in business that they need, but that's learnable and implementable. So yeah, does that answer that?
Yeah, no, super helpful. There's a few questions on how do we scale this, which we've touched on a bit. KKR and private equity moving into it. We've talked about policy at federal level. How do you think this does scale, and how does it scale? We use this term in impact investing with integrity and with guardrails and ensuring that the benefits actually are shared widely.
Yeah. So, I mean, I want to, echo a few things that we said already. I think certainly at the local level and the national level, there's a role for government to play here in terms of scaling and supporting employee-owned businesses in the same way that conventional businesses are supported. There's also, I think it's important to note, while we've talked a lot about the benefits of employee ownership, it's not a panacea. It's not going to solve all of our problems, and it's not a fit for every single business. But it is a really good tool for folks to use to solve specific social and economic challenges. And I think, the more that we're able to have conversations like this and really think about or allow people to consider, where do I fit into this picture? How do I connect the dots here between what employee ownership does and the impact that I'd like to see locally? Then we're able to have, I think, more people sort of come into the space here. We focus here at Dowie on really enabling a lot of partners to take up the work that we do. We have a three-step model that we like to promote. One is demonstrating successful solutions. The second piece is enabling our partners to use those solutions in their work. And the third is embedding those solutions in institutions of power. That's really, I think, a three-step process to scaling, but it really requires folks who aren't just focused on employee ownership to use this in their toolbox in their everyday work.
Yeah, I love to hear the demonstrate, enable, embed. So, I guess I have two thoughts on this. One is that we scale by building the broadest possible tent, the biggest sort of canopy that covers everything from the most democratic collective small worker co-op up through things like equity compensation and granting a one-time share ownership. I think we are under the same tent, and we have to get comfortable with that, and sort of sniping and comparing, and our model is better than that. There's a need for clarity about what you mean when you say a model. I think that's really critical. But if we look at sort of the broader mainstream economy, and particularly investor-driven, investor-owned forms, are not necessarily sniping and comparing and competing. They're under a big tent, and they're scaled. And so I think sort of not holding ourselves to a single answer standard is really critical. We have to aggregate resources. We have to consolidate at the resource level so that we can broaden at the ownership level. And that's gonna take some uncomfortable relationships. Investors who can't stand each other collaborate all the time, right? So I think that's our challenge. But to the question of how you maintain your values, I think it's really interesting. I came into the cooperative movement at a time when it was still pretty utopian and countercultural. And I guess I have always interrogated the notion that values are necessarily utopian or countercultural. I think it does a disservice to our values to say they only live in certain ways that look, certain communities or certain words or certain habits. I think there's a huge universe of values-based business owners, of people who want to enact their values at work, who maybe don't think, look, or talk like what we think of as values-driven business owners, and it's our job to uncover that and to offer tools that help them enact values from a really broad perspective.
Love that. I would say, just to add quickly, I think the question of scale, as investors, we tend to think about scale purely from a financial perspective, and I think that with the ownership question, scale doesn't necessarily mean only financial growth, but it means kind of how can we distribute these models more widely, and so I encourage us to maybe think about wider distribution versus just scaling. Worker cooperatives specifically are not designed to scale to become massive. They're designed to root and distribute resources. And so I think there's maybe different language that we can use to ground us in some of those values and not lose sight of those. And yeah, I think I agree from a systems perspective. There's different roles for everybody to play, from the policy side, from the investor side, from just being a champion on the side and practicing sharing leadership and sharing responsibility in our day-to-day. And there's kind of a ripple effect that can have as well.
Let me piggyback one thing. Oh, sorry, we're out of time.
Well, last
one last thing. I think we underestimate the power of the second level up we focus so much on the businesses and businesses scaling. It is like, the vast majority of businesses owned by people of color are micro businesses. They're under, three people and under. And so those may not become worker owned or employee owned, but they sure can collaborate for back office services, shared purchasing in what we call a secondary co-op or a similar model. And I think looking as investors, looking at that secondary layer as well as at the primary layer is one of the keys to scale, which just reminded me when you said that.
Fantastic. Well, I mean, I hope, as folks come into this space and it grows, we love to see it, but there's a wealth of knowledge already here. Please thank our guest. Thank you all for coming out today.